Why are long-term asset class returns so important? We know that long-term asset class returns aren't sexy. We all want what's hot right now. We live in like the me generation, right? Everything is what's now, what's next year, what's cool. We know that long-term tried and true methods aren't sexy, but they are the best approach to wealth building. Otherwise, they wouldn't be long-term and tried and true. Past performance is not a predictor of future results, but it helps us understand where markets really are for real investors. You have long-term goals like building wealth, retirement, and other things that are going to take years and years to accomplish. So a long-term period is much more representative of what's possible from an investment standpoint than just what happened last year or what we expect to happen next year. Thus, we don't want to get stuck in short-term thinking as we begin to reflect on the investment opportunities that are in front of us. Over the last 30 years, real estate has been the top performing asset class, while stocks, the S&P 500 in particular, have made up a lot of ground with strong returns over the last 5 years. You'll see those at the top of the chart significantly ahead of the remainder of the asset classes that are on the page: gold, bonds, and inflation. Both of those asset classes, stocks and real estate, have returned at north of 10% annually over the last 30 years, providing more than 18 times the original investment. It's also worth noting that inflation is up almost double. That means that if you had simply held cash over the last 30 years, you would have lost almost half of your purchasing power, even though you had the same amount of money in the bank. So investors need to be invested long term in order to compound their wealth and stay ahead of inflation's impact on spending power. In order to compound assets and truly build wealth, some exposure to risky assets like real estate or stocks is also necessary. Now let's zoom in and look at this over the past 10 years. Over the past 10 years, low interest rates have plagued bonds and have driven stocks and real estate to be the top performing asset class in our universe. Rates have continued to decline, but more modestly than earlier in the 2000s, which has limited the performance of bonds. Again, you'll see bonds, gold, and inflation down there towards the bottom. Gold has also lagged until very recently, and notice that gold and bonds have provided little to no advantage over inflation during the past decade. So if we want to invest and stay ahead of inflation, again, it's the S&P 500, it's stocks, it's riskier assets, they're going to do this. So what does all of this long-term thinking mean? In order to truly grow portfolios over the past 30 years, over the past decade, and build wealth, you must invest in riskier assets like stocks and real estate. Otherwise, your returns would be much closer to simply staying at zero, slightly ahead of inflation, and maybe even declining as your purchasing power erodes over time. Looking at long-term results also helps us when we go through periods of market distress. Typically, those periods are really short-lived versus our entire investment lifetime, but they don't feel that way in the moment. So keeping a long-term perspective helps us make smart investment decisions during challenging times.